While everyone is watching the 1 hour charts and obsessing over minor price fluctuations, the real story is happening in the corridors of power in Washington, D.C., and it is a signal we have not seen since the inception of this asset class. Most people are looking at the wrong chart because they are focused entirely on price history. But the smart money is currently pricing in a fundamental shift in the regulatory landscape that changes the game entirely. If you are wondering why Bitcoin is showing such resilience despite macroeconomic headwinds, the answer lies in a perfect storm brewing between the upcoming election and a specific piece of legislation that just passed a major hurdle. We are looking at a scenario where Bitcoin is not just trading on speculation, but on the verge of being legitimized by the world's largest economy. Let us look under the hood at what is actually driving this push toward $90,000. Because it is not just retail hype. The narrative has shifted aggressively due to two massive catalysts that are converging at the exact same time. First, we have the former President Donald Trump making an explicit pivot toward the cryptocurrency industry. This is significant not because of politics, but because markets hate uncertainty and they love a clear path to deregulation. Trump has publicly shifted from skepticism to openly courting the crypto vote, accepting donations in digital assets, and promising to stop the hostility coming from current regulators. For institutional investors, this reduces the perceived tail risk of a total government ban or a stifling crackdown. When you remove the existential threat from an asset class, the risk premium drops, and capital that was sitting on the sidelines starts to flow in. The market is currently pricing in a higher probability of a pro-crypto administration taking office, and that acts as a magnet for long-term liquidity. But the Trump factor is only half of the equation, and frankly, it is the more speculative half. The second, and perhaps more concrete catalyst, is the progress of the FIT21 Act, or the Financial Innovation and Technology for the 21st Century Act. This is the most significant piece of crypto legislation to ever pass a chamber of Congress. The reality is much simpler than the legal jargon suggests. This bill essentially hands the majority of oversight to the Commodity Futures Trading Commission, rather than the Securities and Exchange Commission. Why does this matter to your portfolio? Because the Commodity Futures Trading Commission is viewed as a much more pragmatic and market-friendly regulator. For years, the industry has been suffocated by a regulation by enforcement approach, leaving major players guessing about the rules. FIT21 provides the clarity that Wall Street legal teams require before they can allocate billions of dollars into this space. We are talking about pension funds, sovereign wealth funds, and massive insurance endowments that cannot touch an asset class that exists in a legal gray area. If this bill becomes law, or even if the momentum continues to build, it effectively unlocks the floodgates for institutional capital that dwarfs the ETF inflows we saw earlier this year. This is why we are seeing a structural breakout on the higher timeframes. If this deep dive into the regulatory landscape is helping you see the forest for the trees, consider joining our community with a subscribe to stay ahead of the herd. Now let us look at the data evidence that supports this bullish thesis toward $90,000. We are seeing a significant liquidity shift in the stablecoin market. The market capitalization of stablecoins is rising, which is historically a leading indicator of incoming buy pressure. This is dry powder moving onto exchanges, waiting to be deployed. Furthermore, if we analyze the funding rates across major derivatives exchanges, they remain healthy. We are not seeing the excessive leverage and euphoria that usually signals a market top. Instead, we are seeing a slow, grinding accumulation phase, where whales are buying the dips while retail traders get shaken out by short-term volatility. The on-chain data shows that long-term holders are refusing to sell at these levels. The supply of Bitcoin on exchanges is at multi-year lows. This creates a classic supply shock scenario. You have a fixed supply, which was recently cut in half by the halving, meeting a potential demand shock driven by political legitimacy and regulatory clarity. When you run the numbers, a move to $90,000 is not actually that aggressive. It would represent a market capitalization that is still a fraction of gold. And frankly, it is a conservative target if the United States government officially embraces the industry. We have to look at historical parallels to understand where we are in the cycle. This feels very similar to late 2020. Back then, the narrative was about Paul Tudor Jones and Michael Saylor entering the market. It was the initial phase of corporate adoption. Today, the narrative is about political adoption. Just as corporate adoption drove us from 10,000 to 60,000, political adoption has the power to drive us from 60,000 to 90,000 and beyond. However, as a strategist, I must also highlight the downside risks because we do not trade on hope. The path to $90,000 will not be a straight line. There is a lot of resistance around the $72,000 and $74,000 levels. These are historical supply zones where early investors will likely take profit. We also have to consider the macroeconomic environment. Interest rates are still high, and the Federal Reserve is still watching inflation data like a hawk. If we get a hot inflation print or if the economy takes a sudden downturn, all risk assets, including crypto, will take a hit in the short term. Also, the political landscape is volatile. If the FIT21 Act stalls in the Senate, or if the election odds shift dramatically, we could see a rapid unwinding of this Trump trade. Therefore, the playbook right now is not to go all in with maximum leverage. The strategy is to identify key support levels and accumulate spot positions or low leverage longs. We want to be positioned before the news becomes official. Most retail traders wait for the bill to pass or the election to happen before they buy. By then, the price will likely already be at $90,000. The smart money buys the rumor and sells the news. But in this case, the news implies a multi-year secular bull market, so they might not even sell. We are looking for a weekly close above $74,000 to confirm the next leg up. Until then, we are technically in a consolidation range, albeit one with a massive bullish bias. It is crucial to watch the dominance of Bitcoin as well. In this phase of the cycle, especially with political uncertainty, Bitcoin tends to outperform altcoins as investors fly to safety and quality. Do not get distracted by lower cap coins promising 1,000% returns right now. The liquidity is flowing into Bitcoin because it is the asset that is being discussed in Washington. The institutional capital that is waking up to this opportunity is not looking to buy a meme coin. They are looking to buy digital gold that is sanctioned by the state. The $90,000 target is derived from Fibonacci extension levels and realized price metrics. If we break the all-time high with volume, the price discovery phase can be explosive. We have seen this movie before. When the psychological barriers break, the fear of missing out kicks in, not just for retail, but for asset managers who are underweight in the best-performing asset class of the decade. The kicker here is that the United States is effectively in a race with other nations. We are seeing Hong Kong and the United Kingdom moving fast to establish their own crypto hubs. The United States politicians know this, and they do not want to lose the technological edge. This geopolitical competition is another hidden tailwind that most people are ignoring. It forces the hand of regulators to be more accommodating, regardless of who sits in the Oval Office. However, the specific combination of Trump's vocal support and the legislative framework of FIT21 creates a unique window of opportunity. It validates the thesis that crypto is here to stay. For the last 2 years, the bear case was that the government would kill crypto. That bear case is essentially dead. Now, the market has to re-rate the price to reflect that survival and integration. That re-rating process is what takes us to $90,000. If you found value in this deep dive and want to help the algorithm share this data with more serious investors, a like goes a long way. To wrap this up, remain objective. Do not let emotions dictate your trade. Watch the exchange flows. Watch the prediction markets for the election. And watch the progress of the bill in the Senate. These are the 3 pillars that will support the move to the next level. We are witnessing history in the making, where an asset once dismissed as magic internet money is becoming a central topic in a presidential election. That alone justifies a significantly higher valuation. Stay sharp, manage your risk, and do not get shaken out by the noise. Disclaimer. The content presented in this video is for educational and informational purposes only and should not be construed as financial, investment, or trading advice. Cryptocurrency markets are highly volatile and carry a significant risk of loss. Always conduct your own due diligence and consult with a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results.